Ladies and gentlemen, good day and welcome to the Birla Corporation Limited Q4 and FY26 earnings conference call hosted by HDFC Securities Limited. As a reminder, all participant lines will be on listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I would now like to hand the conference over to Mr. Rajesh Kumar Ravi from HDFC Securities. Thank you, and over to you.
Thank you, Yashashri. Good day, everyone. On behalf of HDFC Securities, I welcome you all to Birla Corporation's Q4 and FY26 earnings call. The Birla Corp will be represented by Mr. Sandeep Ghosh, MD and CEO, and Mr. Aditya Sarogi, Group CFO. I now hand over the call to the management for their opening remarks, which will be followed by Q&A. Over to you, Sandeep, sir.
Very good morning or good afternoon to all of you. Thank you for joining in such large numbers on a Monday morning. We know Mondays are busy days and lots of activities have happened around the country, lots of announcements. So we don't want to take too much of your time in today's call. Most of our statements have been contained in the press release, which you have seen and which I find has been also captured by many of the analysts. So we will dive straight into some of the operating parameters and then get into your questions. So this is Sandeep Ghosh, Managing Director, Birla Corporation. With me, I have Mr. Aditya Sarogi, our Group CFO, and on the operations side, I have Mr. Rajat Prushti, who is our CMOP, the Chief of Manufacturing and Projects, and Mr. Kalidas Pramanik, who is our CMO, Chief Marketing Officer. He is present here. In short, as you would have seen, we had during the year a few challenges and marginal setbacks, especially in regard to the operations of a couple of our plants. But we were, I think, able to overcome them, and also sticking to our strategy. We were able to make the most of the tailwinds which one observed during the last quarter and take the most advantage of it in the marketplace as well as in our operation side, and been able to deliver a healthy set of numbers, we believe, or which we find satisfactory for ending the year on a reasonably good note. As we look forward, I know we are all staring at many uncertainties and variables, so any kind of projection has to be tempered with caution for the unknowns which would be applicable to all, not just all companies in the industry, but the country as a whole, and maybe the entire global economy, especially some of our neighboring countries. So we are sort of taking it as it comes, and will not be making, as it is, we don't make much of forward-looking statements, but even going forward, I think we will be cautious in our guidance for the months ahead. We are in a very, very dynamic and volatile situation, as you would know, from the day we declared our results on Saturday till today. We have had announcements from the Prime Minister, no less than the Prime Minister himself, in terms of some of the clouds looming on the horizon. So we have to look at each day separately and go forward. But I think two things are there. As far as we are concerned, we are on a solid footing in whatever we have done and what we have demonstrated, hopefully, to the market and to all of you who observe the company, follow the company closely, that we are not the ones who do knee-jerk reactions or veer from strategy. We set our course in a particular way 3 years or more than 3 years ago, post-COVID, and we have by and large been able to stick to that, adhere to that, and without getting distracted by temporary ups and downs or some regional imbalances and disturbances. So with that, I hand over to Mr. Adit Sarogi to give you a broad overview of the numbers. He's fresh from the CNBC interview, wherein also he has given, I think, an overview, which many of you have heard, and I found some of you have also reported on that. So we will get straight into it and conclude the meeting as soon as we can. So we would also request you to be focused on your questions and what is relevant, because we may not be able to unnecessarily, speculate much on the future. So those futuristic questions, some of that which sometimes comes up in an actual course, ask only what you think is immediately relevant in the interest of time. Thank you very much.
Good afternoon, ladies and gentlemen. In terms of our performance for this financial year, we have done a growth of about 4% in volume. Our EBIT for the year was close to about 800 rupees, and for the quarter ended March was close to 1,000 rupees. Apart from the quantitative factors, there are certain qualitative factors where we have done. Where we have taken conscious efforts and we have seen positive results. For instance, in respect of blended shipment, we have moved from 82% in the last financial year to 88% the current financial year. In the trade segment, from 70% in the last financial year, we have moved to 77% in this financial year. Our lead distance has come down from 350 kilometers to 337 kilometers in this financial year, and our Mukutban volume has improved from 24.6 lakh tons to 27.7 lakh tons in this financial year. With that, I open the forum for Q&A and will be glad to answer specific questions that you have.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We'll take our first question from the line of Sukrit D. Patil from Eyesight Fintrade. Please go ahead.
Good afternoon to the team. I have two questions. The first question to Mr. Ghosh is, looking ahead, how do you see Birla Corporation shaping its growth in the cement and building materials over the next coming quarters, and particularly in terms of capacity expansion, sustainability initiatives, and brand placement in the premium space? That's my first question. I'll ask my second question after this. Thank you.
It would be helpful if you would have asked your second question as well, but I'll answer your first question. As you know that our capacity, we do not have any major capacity expansion plans, unlike many others who have announced in the past. I do notice that some people who had announced capacity expansion are on a rollback or have announced some rollback or slowdown in their capacity. We have not done any aggressive capacity expansion announcements in the past, so we will proceed according to that. There are no major changes from whatever is already there. We know our Maihar Line 2 is work in progress. Along with that will come the new grinding units, which are linked to that, which will Eastern UP, around Prayagraj, some of those. But beyond that, we are not really looking at your acquisitions, expansions. With the Mayer Line 2 coming by financial year 29, we would go up to 27.5 million tons is what we are looking at. What you would see in terms of our strategy so far, you see our total numbers. This year we have reported the highest ever number with our existing capacity. So what is happening is our strategy of moving progressively towards almost 100% capacity of blended cement. We are making steady progress despite the change in the market composition, because in our markets, core markets where we are, the way markets are expanding and with the investment in brands that we have done over a period of time, we are finding there's greater acceptance of our blended and value-added cement. So you'll find, therefore, the composition of our premium volume in those in our total kitty is systematically increasing, not just across units but across regions also. If you see how our Mukutban volumes are progressing, there again in our core markets we are able to acquire greater market share, and that too through our blended. So this kind of efforts will continue. We've installed our third line in Kundanganj. That will give us again some play in our core and profitable UP market, and all of that will again come from blended cement. Unlike some people who have set up new units, grinding units in Uttar Pradesh, we are aware of, but they are grinding OPC over there. That's not our idea. We want to do it a value-added blended cement, and that to our premium brands. So that is basically how things will move. We are not talking of any big bang expansion just now. There are some, as you know, some mines acquisitions, etc. are happening, but those are much more futuristic, and we'll talk about that in the days to come or years to come. Thank you.
Thank you. My second question to Mr. Aditya is, from a forward-looking point of view, I want to understand your plan of action on how you see capital allocation evolving to balance growth investments, reduction in debt, and shareholder returns, and what structural cost levers are being built today to ensure margin stays strong in the coming quarters. Thank you.
See, in terms of capital allocation, we have got about 4,500 crore CapEx plan undergoing right at this juncture. So where we are taking our capacity, one part we just concluded in the last financial year, where we went from 20 to 21.5. Now in the next 3 years we are going to take it up to 27.5. So most of our CapEx is, most of our internal accrual is going to be allocated towards that CapEx program. So you will not see any debt reduction, major debt. In fact, the debt is going to go up in absolute terms, though in terms of debt to EBITDA, it will not exceed 2.5 is what our outlook is. And as far as the cost reduction is concerned, one major lever is that we have just started production or mining in our Bikram coal block. The full-fledged production is going to come from next financial year. So that is going to be one major lever insofar as cost reduction is concerned.
Thank you and best wishes.
Thank you.
Thank you. Next question is from the line of Shravan Shah from Dolat Capital. Please go ahead.
Hi, sir. Thank you and congratulations on better operating performance this quarter. Sir, before asking question, just to clarify or maybe reconfirm whatever the Sarogi sir has said on the CNBC kind of a 20 million volume in FY27, which is close to kind of a 7% growth, 800 rupees EBITDA per ton, 900 crore capex for FY27 and some 50 odd rupees price hike, which is there in April, and 150 to 175 rupees cost per ton increase from Q1 onwards. So just wanted to reconfirm that this is what that we are looking at.
Just one small variation, I said close to 21 million, close to 22 million tons. I did not give a specific number. I said mid-single digit in terms of volume growth.
Okay. Okay. So in that scenario, so first on the volume front, if I exclude the Mukundban, the entire other capacity, even for entire full year of FY26 is, one can say, close to kind of a 99% utilization is there. So whatever the growth in the volume in FY27 likely to come is primarily on the 1.4 million ton Kundanganj that we have started. That's the way one
we have
can.
some headroom in Mukundban also.
Okay. 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 Got it. And now on the couple of data points, so particularly on the kcal front for Q4, what was the kcal, and in terms of fuel mix also? So you have said that Vikram Core, the full-fledged production will come in the FY28. So this year, how one can look at and how much kind of a saving this year and maybe the next year once it will reach the full-fledged. So what's the cost difference? How one can look at that part?
So, coming to Vikram, this year the annual capacity is about 3.6 lakh tons, and this year we expect to be about 1.2 lakh tons or thereabouts. And next year we expect to achieve full capacity. And to give you a sense on the cost, our landed cost of Vikram is going to be in the region of 1 to 1.05, and the current prices of domestic coal is around 1.45. So that will give you a sense of the cost arbitrage that we will get from Vikram coal block. What was your other question?
What was the kcal cost?
kcal cost in Q4 it was 1.53.
Okay, 1.53. And mostly in Q1, the primarily the packing bag cost, which will be 1,800 rupees, and here also
packing bag and fuel.
Fuel. Okay.
And marginally the diesel cost will go towards increasing the logistics cost a bit.
Okay. Okay. Got it. And just a clarity in terms of the capacity, so 1.4 million ton each for Prayagraj and Gaya phase 1. This we will be starting by FY28 or it would be maybe Q3, Q4, FY28?
Q3, Q4.
Q3, Q4.
Okay, Q3, Q4 that we will be starting. And in terms of the, sir, you said that now we are looking at 100% kind of a blended cement, which will be then the premium share, which will be keep on increasing. So this current 63% premium share, how one can look at to inch up, and the blended cement also 87%, when one can look at kind of 100% kind of a number, and how this will help us in terms of the extra EBITDA?
See, it's difficult to predict exactly how, but what you would see in our, trajectory, quarter to quarter, year on year, if you see, we have been moving in that direction. And this is despite the market composition changing. There is, in most markets, we have seen the growth in non-trade segment increasing, and consequently, there is an OPC segment which has gone up. But we have not been lured by that. We have stuck to our position of pushing our blended cement and the premium cement up, and that is a strategy which we will follow consistently. So we are not veering from that, and that's the point to be noted from your thing, that you'll find that we are doing that in a very consistent manner. But it's difficult to say when we will reach 100 or what is the level we are today, whether that level will remain or there may be a slight slippage or reversal on a quarter-to-quarter basis or something. It can be, those are subject to market variations. but we are extremely clear on that strategy. What is further thing we are going to do on the brands, etc., that only we can't talk about now. But we were the ones who, among the I don't like to use that term, the B category players, we were the first to move heavily towards premiumization, and we have gone in there aggressively over the years, created a new flagship brand, Perfect Plus, which has now got a practically a footprint in all of northern India to central India. It is gained traction and all of it. So that strategy has worked. So we hope to lead innovations in that category, because others have also moved in that direction subsequently who were in the B segment. We have seen some amount of dilution in the equity of the A category players, without naming them, in terms of their price positioning, which has put us at par with many of them, or even higher than many of them in our core markets. So that's the direction we are moving. We have the advantage of being a smaller player with high capacity utilization, so we are not really under pressure to ramp up. As I said, some people who have added capacity are having to even grind OPC, which is a very unusual thing in the grinding units, rather than taking the OPC from their mother unit plants, which are fairly close by. We are not doing any of that, even if there are incentives available somewhere. So we will stick to that, but you can't really predict exactly when we will reach 100%, or whether that 100% will remain constant, or there may be a slight reversal on a quarter-to-quarter basis.
Yeah. Sir, lastly, the incentive in revenue in Q4 is just a 1 odd crore, and if that is the case, how one can look at FY27 incentive on a full year basis?
The incentive in Q4, we have booked 140 crores, out of which about 90 crores was relating to earlier years, and 50 crores was relating to the current year. Okay. And in the current year, we have average quarterly revenue to have been about 24 crores. So you can say to the extent of 24 odd crores, the incentive that we booked in this quarter was relating to the earlier quarter. Insofar as the next year is concerned, with Punjab coming on stream, we expect the incentives to go up to around 130 crores.
Okay, got it, sir. Thank you and all the best.
Thank you. Ladies and gentlemen, in order to ensure that management is able to answer queries from all participants, kindly restrict your questions to 2 at a time. You may join back the queue for follow-up questions. Next question is from the line of Siddharth Dand from Goodwill. Please go ahead.
Yeah, hi. I wanted to understand why the working capital got very tight. It hurt the cash flows from operation. Any particular reason why?
Yes, we consciously started building up stocks because of the geopolitical situation. We were anticipating some tightness insofar as particularly coal is concerned, for coal and the fuel is concerned. So instead of the normal strategy of driving down the inventories, we consciously built up inventories. That day.
Understood. What is the current debt at the end of the year because of the investments? I couldn't get the net debt number.
About 2,100 crores.
2,100 crore was the net debt number. Okay, great. And what do we expect the peak debt, just a range in this CapEx cycle?
In this CapEx cycle, our expectation is that the peak net debt should be in the range of 4,000 crores.
Peak net debt in the range of 4,000 crores. Understood. And what are the interest costs, assuming the current rates that you are expecting for FY27?
It's difficult to give an estimate on that because most of our term loans are linked to external benchmarks.
It's EBLR. Okay.
So that is slightly difficult.
Okay, just one final question for Sandeep sir, that, we keep facing.
I'm sorry, you're sounding muffled, Siddhant. We can't hear you. Siddhant?
Around that business.
Siddhant, please repeat your
Hello?
question. We were unable to hear you.
Yeah, hi. Can you hear me now?
Yes.
Yeah, just for the jute business, have we considered getting in a strategic investor or turnaround, because it's been taking quite a bit of time?
No, we don't have a problem in investing. Jute business turnaround, last year, it was a very exceptional year when jute prices have reached abnormal highs, historical highs it has reached last year. What kind of levels which nobody has seen. It is due to a multiplicity of factors, including the stoppage of imports from Bangladesh and a variety of factors. We feel that, and that has thrown many people out of gear. There are many jute plants which have actually shut down, and jute mills which have shut down, or people have reduced their mandates, the weekly workings to 4 days, 3 days in a week. All that has happened. So this has been a very abnormal thing. Jute, we don't need a strategic investor. We know the business. We have been in the business the longest among any of the current players, management. As you know, is the oldest Indian jute mill. We know what is to be done, but it's a matter of time and the opportunity. We expect now, those forward-looking, that with the change of government in West Bengal, jute will receive a different kind of attention, and there will be greater coordination between the center and the state government, because so far, jute, as you know, is a central textile ministry subject. There has been a lot of interest, especially from the current textile minister, Giriraj Singh, but the center and the state have not always worked in sync. So jute, whereas, say, to give an example, whereas jute is textile is a PLI industry, and there has been a lot of PLI activity has happened in textile for other materials. In jute, nothing has happened. I have personally met earlier the textile minister, Mr. Singh, who has visited. They have been urging the industry to look at innovations, industry to look at new products, rather than rely only on government orders, etc. None of that was really happening. There are a lot of structural, systemic issues. So hopefully, if the government, there is greater attention over there. We have a new head of the Niti Aayog, who, apart from being an economist, he was last time elected from the jute belt. He has gone. So I am personally optimistic in a lot of positive policy changes which will show improvement in the jute industry per se, something which has not happened for many, many years.
Understood. Thank you.
Thank you. Next question is from the line of Saket Kapoor from Kapoor Company. Please go ahead.
Yeah. Namaskar, sir. Hope I'm audible.
Yes, please go ahead.
We can hear you
sir.
even without the phone, because you are just 1 kilometer away from us. Even if you don't speak into the phone, we'll be able to hear you, Saket.
Okay. Thank you, sir, for your comments. Sir, firstly, our foray into the RMC and the construction chemical business, if Sandeep, so you can outline to us what are we eyeing and exactly in this space where we intend to make our mark?
First of all, on RMC, our strategy of RMC is very different from others, in the sense that many other people who are investing in RMC, including the largest players, they look at RMC as a channel for their own cement, because their own capacity utilization of cement is much lower. So while they're also trying to certainly move up the value chain, but one of their main drivers is they can use their own cement. Whereas for us, the RMC is a matter of certainly climbing up the value chain, but it's more importantly a question of brand extension. It's a question of leveraging. We as a company, I have said this in the past, when we look at assets, we don't look at assets as just manufacturing assets. We look at our marketing assets, though you don't assign a value to them on the balance sheet. We are very conscious of our marketing and sales and distribution assets. And we think that just like one sweats the manufacturing assets, there is a scope to sweat the marketing and go-to-market assets, and that is what we intend doing with RMC. So our RMC progression so far has been slow but steady. We are now very soon we'll have our 5th plant in Uttar Pradesh, and that's because Uttar Pradesh is a core market for us where we have a strong brand equity for Perfect Plus. So our RMC is being marketed and under the Perfect Plus brand name. We are doing so, but we don't want to really go overboard on RMC. We know how many companies have burned their fingers. There are a lot of issues in the RMC segment, particularly relating to outstandings, your recovery and commercial aspects. So we don't want to do something aggressive, over-aggressive, which is going to hurt our main business. So far, first of all, I think we are developing a reasonably good footprint in UP market, which is giving us a lot of learnings. You will probably get to see our progressing now, extending the same format to other regions where we have a strong brand equity. On chemicals, extension chemicals there were 2 parts to it. When we launched it, there was a part of wall putty and there was a construction chemical. Wall putty is a market which we have seen is highly price driven, and a lot of new entrants have come in, not only from the the cement and side, but also from the paint side. So it is a very, very commoditized market. We don't see too much of value, so we are not going aggressive on wall putty at the moment, but we are seeing a lot of traction in the chemicals side. And there again, we are having a brand synergy with our premium brand Perfect Plus, and we are changing our supply chain model there over learning, and you will see us trying to scale it up in the coming year. It had, because of in between COVID, everything else, it was put on the back burner for a while, and we were focusing on other areas, but you will find now much more focused attention on chemicals. But chemicals is never going to be a huge number. It is going to give you again a brand extension thing, and which is which will probably give us a sort of a multiplier effect on our existing brands. We are not really looking at it in a huge number, but it is going to certainly, we believe, add value to our overall brand assets and position.
And sir, in terms of capex, any numbers, any significant number we will be assigned in this segment?
These are all capex-like projects.
Okay. My next question to
Saket, I request you to join back the queue, please, as we have participants.
Ma'am, second question only I was asking.
Okay, please go ahead.
Thank you, ma'am. Saravgi sir, as you have alluded in the interview also about the power and fuel costs. So with the rising crude and the petcoke prices, how are these going to affect our fuel prices, and what steps are we taking to improve our mix in terms of further investment in the WHRS? And also please provide us the current maturity number of debt for the current year, and what number we are going to close for FY26-27. Thank you.
See, in terms of The total cost impact, I have given an estimate of 150 to 175 rupees per ton. That is mainly on two counts. One is the packaging cost and the other is the fuel cost. Okay. And within the fuel, our current mix of imported fuel is around 30%. But let me share with you, it's not only the imported fuel cost which is going up, even the domestic fuel, although the cost is relatively less, but even the cost of domestic fuel is going up because many cement players are now switching from imported fuel to domestic fuel because and also given the strong summer season, there is a strong demand for domestic fuel. So even the cost of domestic fuel is going up. And insofar as wastage recovery is concerned, we are trying to optimize the capacity of existing wastage recoveries wherever possible. And in any case, our new plant will have a optimized level of wastage recovery in the Mayer line. Solar also.
Didn't get your last point, sir. Didn't get your last point.
Yeah. No, there are two things, Rajat here. Yes, wastage recovery as said by Aditya. Yes, we are working on that to improve our efficiency in the wastage recovery, including the new setup which is going to come for the Mayer line 2, that will be there. And apart from that, the solar and hybrid also, we are continuously working on that. And as of now, you can see that there is another plan of around 25 to 30 megawatt, which is going to improve in next 1 to 2 years of time.
Thank you. We'll take our next question from the line of Patanjali Srinivasan from Sundaram Mutual Fund. Please go ahead.
Hello, sir. Thank you for the opportunity, sir. Good set of numbers. I just have a couple of questions. So firstly, with respect to our operating cash flows, so we have generated more EBITDA than last year. However, our operating cash flow has kind of declined very sharply versus the previous year. Could you help me understand this bridge, sir, versus the previous year? Why there's such a sharp decline?
Some of the incentives that we have accrued, particularly for Maharashtra, that we have not realized. So hopefully by next year, we'll start realizing that incentive. So that is one. Secondly, as I explained, the working capital has gone up because of the conscious effort to increase the fuel inventory. So that is the second reason for lower cash flow.
Sir, what would the receivable amounts be, sir, pertaining to this incentives for us?
Well, total receivable is about 500 crores.
Got it, sir. And we expect this to be coming in the current year, is it?
Yeah, we should start seeing realization from the current financial year.
Got it, sir. And just one last question, sir. What is the capex guidance for 27 and 28, and how much capacity commissioning for the next 2 years?
We have not given any guidance for the next financial year. For FY27, it is 900 crores, and our capacity addition by FY29 will be 6 million tons, from 21.5 to 27.5.
Got it, sir. Any timeline when the first next set of capacity is coming in?
All in FY29. Some
okay, sir.
At the beginning of the year and some towards the end of the year.
Thank you so much.
Thank you. Next question is from the line of Girija Ray from Nirmal Bang. Please go ahead.
Hi, thanks for the opportunity and many congratulations for a good set of numbers. Appreciate the consistency level of the company, and the fourth quarter is a kind of surprise to the street, I can say. So I have a couple of questions. So just wanted to check Brahmapuri and Markibaka coal block, when we can expect it has to be operated or something like that. If you can throw some light. This is my first question.
As far as Brahmapuri is concerned, we are not pursuing that block actively because the capacity which was given in the bid document, the actual capacity is much lower than that. So we are contesting that particular block. And insofar as multi-bulker is concerned, we are in touch with the government for certain regulatory issues. So maybe by FY29 is what we expect to start that job by.
Okay. And do you think this Bikram coal that we have started operating in April, so this is going to reduce our lead distance in terms of coal transportation, overall company lead distance? Is it going to reduce our coal distance? Because I can see Bikram coal mining is around 50% distance reducing from your central region plants. So is this going to help us to Mukutban and central regions if we are from this Bikram coal mining?
See, the lead distance does not matter, but what matters is the landed cost that we pay for the fuel compared to the alternatives. If we were to buy from the market or from Coal India subsidiary. So there, as I explained, there is a good delta. Our cost, landed cost, will be in the region of 1 to 1.05 rupees per million calories, as against the current market price of 1.45 rupees per million calories.
The last question, if I may. I could not hear it properly. What is the incentive we have included in FY26 revenue, full year basis, and what is the amount we are going to add in FY27, the incentive?
We have accrued 140 crores, out of which 90 crores pertain to earlier years and 50 crores pertain to the current financial year.
And for FY27, what is we are expecting incentive?
130 crores.
Okay, fair enough. Thank you, sir. Thank you very much, and all the best.
Thank you. Next question is from the line of Harshal Mehta from AMSEC. Please go ahead. Harshal?
Thanks. Hello, am I audible?
Yeah, please use your handset mode.
Is it better now?
Yes, please go ahead.
Okay. Thanks for the opportunity. Just one clarification in terms of incentives. So broadly, for the full year, you book around 50 crore incentive. And how much is that for Q4, that number?
No. For the full year, it is around 95 crores. Out of which, excluding the 90 odd crores that was pertaining to earlier years. So for this current year, it is about 95 crores, out of which about 48 crores has been booked in this current quarter.
So what is the number for this quarter, Q4?
Q4, we have booked 48 crores. And one can say probably 24 crores could have been booked in earlier quarters, but because the clarification was received in the current quarter, that's why we have booked 48 crores. Annual run rate of Maharashtra incentive is expected to be about 90-95 crores.
Okay. Thank you.
Thank you. Next question is from the line of Nikhil Gandhi from Bajaj Life Insurance. Please go ahead. Nikhil, your line is unmuted. Please go ahead with your question. Since there is no response, we'll move on to the next question from the line of Prashant Shah, an individual investor. Please go ahead.
Hello, is my voice audible?
Yes, please go ahead.
Good. And thanks for the opportunity. Congratulations, team, for an excellent set of numbers. Saravagi sir, just to confirm, the lead distance now is 337 kilometers and the kcal is 1.53. Are these numbers, what I understand, is correct?
Yes.
Okay.
For March.
For March, okay. Out of the total energy, so my first question is, out of the total energy cost for the current fiscal, how much total energy?
I'm sorry, you're sounding muffled. Can you repeat the question again, Prashant?
So my question is, how much of our energy consumption is coming from renewable sources in terms of percentage, and how much is the non-RE part?
31% renewable energy.
And how much do we expect?
The power. Total
Power. That is for power.
power consumption.
Fuel, there is no renewable as such.
Okay. Okay. And what is our expectation? How much will it go to in the FY27-28 period?
38%, no?
37 to 38%.
37-38% is what we are trying to get it to.
Okay. And what is our kcal?
Kcal per ton of clinker you are asking, or paisa per
Per ton of clinker. Per ton of clinker.
That varies
from plant to plant also.
Plant to plant. Yeah.
But towards the range of 710.
Okay. Okay. That's all from my side. Thank you.
Thank you. Next question is from the line of Munzil Shah from NSFO. Please go ahead.
Good afternoon, sir. What will be the total capex for this addition from 21.5 to 27.5?
4,760 crores including GST. Ex of GST, it is about 4,300 crores.
Okay. And means I just missed the opening, but there is some guidance of close to around 1,600 crores EBITDA for financial year 27.
Sorry?
There is a guidance of 1,600 crores EBITDA for financial year 27.
So we have not given any specific guidance. We expect the EBITDA to be similar range to the previous financial year.
No, because I just wanted to clarify. I heard somewhere that 2 million ton into 800 rupees EBITDA per ton.
That you can do your own calculation, right? We have not
Sure.
given any.
Thanks a lot, sir. Thank you. Thank you very much.
Thank you. Ladies and gentlemen, we'll take that as the last question for today. I now hand the conference over to management for closing comments. Over to you, sir.
Thank you very much. We appreciate your support. We appreciate your interest in the company. Pleasure talking to you. And hopefully we won't disappoint you going forward. And despite, as I said, the uncertainty hovering in the horizon, we will stick to our strategy and do better than our best. Thank you very much.
Thank you. On behalf of HDFC Securities, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.